The basis trade is what we've seen happen just last week with the stock market and the bond market moving in opposite directions. And it was, in essence, the bond market coming this close to breaking. It's the exact same thing that happened with long-term capital management, the hedge fund, I think in the late 90s, that the Fed had to bail out because it was this close to breaking the entire system. And by the way, long-term capital management was a grouping of Nobel Prize-winning economists. And I think these were the smartest of the smart. They figured it was a risk-free trade. In essence, what they do is they buy as many 10-year treasuries as they can, and they lever up on it by going massively levered with using derivatives to buy as many 10-year treasuries as they can, and then simultaneously they short the 10-year treasury future, which has a little bit of a premium to it, and they just capture the spread because when it expires, they net each other out and you just keep the premium, and that's supposedly a risk-free trade. Because of the Dodd-Frank Act, and these banks can't do speculative things anymore. That's what they do. They buy all of these treasuries, and the Fed likes that because we've seen central banks selling. So get the hedge funds to load up on treasuries, to massively use the collateral, if you will, to use the fractional reserve system type of environment of levering up those treasuries as much as 100-fold. Even at 20-fold, a 5% drop wipes out the whole thing, but at 100-fold, a 1% drop wipes out the whole thing. So you have these banks who think it's risk-free. They buy treasuries and sell treasury futures to simultaneously capture the spread. Well, what happened was last week when the 10-year treasury went up by 60 basis points at the same time the S&P dropped by 8%. They're supposed to move inverse of each other. If the S&P is throwing up, the money should be running into treasuries, into the safety of treasuries, which would lower rates. But in essence, what happened is the rates started to spike for whatever reason, which blew out the short-term lending rate. So those short futures got margin called, and because it went up so fast, it went up 60 basis points in 3 days. It's the biggest jump in bond yields in 3 days since 1982, and it's probably the sharpest split between bond yields and stock prices ever. And so what happened was all of this selling, these hedge funds got margin calls and had to sell their treasuries, which pushed rates up even higher. And this is exactly what happened to long-term capital management. And so you're talking something that was hopefully contained, but it goes to show the amount of leverage that's in the system. And very easily, at the exact same time, we have $6 trillion in treasuries coming due next month. We have $28 trillion due by 2028 with only roughly $15 trillion in tax revenue. That's a problem. How do you come up? You're 50% there and doesn't even take into account the spending we're doing between now and then. So a lot of people talk about, Trump was trying to push the stock market down, talk it down so that rates would go down. People would jump into get out of the risk on trade and move into the safety of treasuries, which would push yields down to refinance this $6 trillion in debt that comes due next month. It went the other way. At the same time, this is when we need it most because our foreign investors are losing confidence in this, especially as the trade unwinds and these funds are forced to sell. It causes sudden and violent moves in the bond market, the debt market. And how much longer are these creditors of ours going to keep lending us money for 10 years at 4% with this kind of volatility when our deficits are running closer to 7% of GDP, when inflation's running higher than 4%, and we have this kind of volatility? This leverage created by the hedge funds that very quickly can blow things up by almost 1% in 3 days. That doesn't move that way. So anyways, crazy times and scary volatility in the bond market and the stock market goes to show how fast things can get out of control. What we see happening right now with China, we give a 90-day hold or a 90-day reprieve on these tariffs. At first blush, you think, yeah, it is unfair. We pay tariffs and they don't. But is it really unfair? Because all of these countries that are selling us their goods because we're a more wealthy, industrious nation, of course, you're going to have a trade imbalance here. The trade gap will look ugly on paper, but, and sure, he wants better terms, Trump does. But the idea here is that these countries who we're buying their goods or they are selling us our goods, they're our creditor in the respect that they're keeping us afloat by buying our treasuries, and they're keeping us afloat by using our dollar as the global reserve, which keeps our interest rates low, which keeps our asset prices high, which keeps the goods that the consumers buy cheap. So sure, the trade gap doesn't look good, but is it fair that we impose these sanctions and we expect these countries to put proceeds into treasuries to support this lifestyle of ours and keep rates low and to use the dollar? And to that point, we are rattling perhaps the wrong saber or barking up the wrong tree. We talk a lot about Project Enbridge and how that got pulled away. Well, here it is again, rearing its head in a different manner, and they're not calling it Enbridge. Let me read something to you. The People's Bank of China, I read yesterday, has announced that its digital RMB renminbi cross-border settlement system is now fully connected to 10 countries. These are the countries in Southeast Asia and 6 Middle Eastern nations. This development enables approximately 38% of global trade to bypass the traditional SWIFT system, which is predominantly used for transactions in the U.S., allowing these trades to be settled directly in digital RMB. And here's the thing. It highlights in practical terms China's digital currency bridge, this is the M-Bridge, has significantly reduced cross-border payment processing times from a typical 3 to 5 days associated with SWIFT to approximately 7 seconds. For instance, a pilot transaction between Hong Kong and Abu Dhabi demonstrated that a company could pay a Middle Eastern supplier using digital RMB, eliminating the need for multiple intermediary banks and achieving a real-time settlement with a 98% reduction in handling fees. This advancement is part of China's broader strategy to internationalize the renminbi with initiatives like the Belt and Road, which we've talked about, and the challenge the dollar's dominance in U.S. dollar and global trade. So here you have it. You're pushing these countries into not only joining BRICS like Indonesia did, but to taking this technology and integrating it in with all of the countries that aren't even in BRICS yet. They're all coming together, including the Belt and Road, which is 75% of human population and 50% plus of global GDP. You have to wonder again, could this be intended? Is this what they're trying to do? And under the Biden administration, it was so stupid. It was too stupid to be stupid. That's why I thought it. But here, again, this is why, this is where conspiracy theories are born. Is he the Trojan horse or is he riding on it? I would vote for him again. I'm glad he's here. But I'm simply saying some of these moves, as provocative as they are, creating these consequences, does he not know that this will happen? And you're doing this now where you see China and South Korea and Japan get together to talk strategy because of the sanctions, because of the tariffs. And these are countries that aren't really allies. And at the same time, 2 of the 3 of them are the biggest creditors to us in our treasury market. We're pushing all of these countries into alternatives, and it's happening in real time. It's a huge deal. And all of this will be reflecting of higher rates as these countries dump treasuries and go a different direction. Instead of putting the excess reserves, as they always have, into treasuries to keep our rates low and support our debt binge, well, now they're putting it into gold, into other things. What is gold? But the only other tier 1 reserve asset next to treasuries, and it's doubled the performance over the last 25 years. And look at last year, it was up 40%. The treasury was up 4%. Easy decision, no counterparty risk. Same trend we're seeing happen right now. So anyways, these are times where there's so many balls and angles. It's like watching, a pinball bounce around. It's hard to follow it and know where it's going next. But I think what's happening with the bond market is symptomatic and emblematic of bigger problems ahead. But it's crazy. You got Goldman Sachs, of course, in their private letters, not the ones sent out to the public, and no mention by the mainstream saying that their low-end prediction for gold at the end of the year is 35.50, that if they see more ETF inflows to the pandemic levels, 38.80 by year-end, and it could get possibly near 4,500 an ounce by the end of 2025. That's coming from Goldman Sachs. And we don't hear any talk of this. We have gold at 3,300 and no one is talking about it. It's invisible to the public. And I don't know how it all plays out, but I'll tell you that we are far from the end of this game because, as you know, the fact that gold is at these levels and the mainstream public is asleep, there's very little, if any, retail demand pushing the price higher. And so when you realize that this has been driven again by the big money, as we've often talked about, the hedge funds, the family offices, the sovereign wealth funds, and the central banks, and the average person is, again, missing this altogether. That's what's so special about silver. Look, silver's been held down, and I will, to the day I die, believe it's the military-industrial complex and their desire not only to make weapons. BlackRock owns all the weapon-making companies just about, and they're the custodian of GLD and SLV, and they pay for and make the bombs to blow up the countries and then win the contracts to rebuild the countries. It seems like a pretty sweet deal for them in terms of money. They needed to keep silver cheap in order to do it, but things around the world are breaking, whether it be deliveries into the COMEX, the deliveries out of the LBMA, which are breaking the system. China flying around the world and buying doré and concentrate as the second largest producer in the world. All of these things are saying that silver is, in my opinion, the asymmetrical champion, the risk reward, low downside, high upside. It is maybe the most undervalued, best bet of an asset class on the planet. And yeah, it's easy for me to say it as a guy that owns a gold company. I'm tired of even defending that. If you don't see that for what it is, you're not paying close attention. And yes, it's enough to make you pull your hair out of your head, but it will catch up and perform similar to gold, only I believe at a much higher clip in terms of percentage gain. And even if you buy silver with the intention of someday converting it to gold, if all it does is fall back to its 150, 200-year average of mid 40s to 1, it's a double. If you could buy 10 ounces of gold today, you put the equivalent into silver, and when the ratio corrects just to its average price of nearly 2 centuries, you're still 6 to 7 times off of what it's coming out of the ground at that price. That's a long way from where it should be. It's a double plus. So yeah, I think it's an opportunity we don't see very often. When people hear that the hedge funds are the ones doing this, and the Fed has even floated there's been talk of them bailing out the hedge funds. The positions are that big. Some people say, well, let them go down, let them suffer. But who's borrowing them the money to make these levered trades? That's right, that's the banks. So when you talk about rates that are spiking, it could, in theory, blow up some of the biggest banks on the planet, let alone the brokerages. The great taking comes into play. This could have rippling effects through the insurance companies. Of course, rising yields are not healthy for the real estate market, for the stock market, for the bond market, for the banks, for the insurance companies. It's a very big deal. This is what happens when you create a reality for 3+ decades of suppressed interest rates and easy money, which creates distortions and misallocations of resource and capital. And the distortions in the asset prices are greatly distorted when the thought of yields rising above 5% sends massive shockwaves through the entire system. Well, what if they blew through that because everyone dumps simultaneously? This is the same thing that I talked about for years under the Biden administration. It was too stupid to be stupid. Well, what if this current administration actually agrees with that, thinks that we have to reset the system and it's better to do it by other countries dumping the dollar? We warned them, how can they do it to us? And well, here's what we're going to do to retaliate, blah, 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 rather than just the flat out reality of the fact that how the hell do we pay $28 trillion in treasuries that come due in 3 years with only $15 trillion in tax revenue? How do we continue to fund our military, a $1 trillion military budget this year that's all discretionary, in meaning we need to borrow money by selling bonds? Well, what if no one wants to buy our bonds? Well, that means that you have to see the Fed come in and buy them by printing money, which creates inflation, which all roads lead to the same place. We're trapped. The Fed is trapped. So I think that's, to average mom and pa, they're a long ways away from the hedge fund world, but the ramifications, the systemic nature of a system that actually contemplates bailing out these companies, because what it would do to the whole system is real. And a system that is as over leveraged and indebted as ours is very dangerous. You bring down one very large bank because of these decisions, the ramifications goes all the way out to middle America and mom and pa, and not just the big hedge funds and the banks on Wall Street.